Hey everybody, welcome back to the show. Another live Q&A for this Monday evening. And as always, if you can give me a thumbs up in the chat, let me know everything's working. I just started a poll question. Have you ever, let me see if I can pull it up again. Have you ever attended a free dinner, retirement, or investment seminar? There's a reason I'm asking that I'll share with you in a second. But if I can get a thumbs up, hopefully. Maybe. There it is. Thanks. All right. Appreciate it. So I want to dive right in to talk about the topic to begin with, and that is the Moody's downgrade of our country's credit rating, which happened, I guess it was on Friday, I think, over the weekend. I think it was Friday. In any event, the markets at first today seemed to not like it, although at the end of the day, I think it kind of ended flat. Let me show you. So this is the actual press release, which, I mean, someone really needs to talk to them about how to format a press release. I don't know. But you can see their rationale for it right down here, which is, again, I don't know, some boldface, maybe, not as wide paragraphs. Anyway, this is much better. So this is a summary from ChatGPT. And the key things are right in here. And, they basically look, debt's going up to 100% of GDP, could go up to 135 or so in 10 years. The one that really catches my attention, this right here, rising interest payments. Like they're saying that, I guess our interest payments now exceed what we spend on defense. That can't be good. They talk about policy gridlock, the fact that, we can't, it's interesting. We have a lot of gridlock, but there's very few people, from what I can tell, in Congress actually fighting to do the things we would need to do to bring down our deficit. I mean, there are some, but, and this is where I kind of roll my eyes when one party wants to blame the other. We've got, the Republicans have got control of Congress. It's a thin margin, but they have control of Congress and the White House. They don't show any signs of reining in the deficit. President Biden for 2 years had control. They didn't rein in the deficit. Now Republicans and Democrats have different, tax priorities and different spending priorities for sure. But no one seems to really, at least not in any majority sense, want to do anything about the deficit. Now, by the way, I don't just blame Washington for that. The reality is, I don't think a president would get elected on a platform that said, I'm going to raise taxes and cut spending, right? I mean, which is what we need to do. We need to do both. And that's probably not going to get them elected right now. Now, someday it might. Things get bad enough. And then the other thing they mentioned, I'll go back to this real quick, this tax policy implications for the current plan, where I guess the plan is to extend the 2017 cuts, maybe add some more. They said it's going to add $4 trillion over the next decade. So, I think Moody's just looked at it. They were sort of the last major credit agency to downgrade the U.S. And they just said, look, this isn't sustainable. And so they downgraded the country's credit rating. Now, the big question for me as I think about these things is, well, okay, so what? I mean, what do I do? Do I do anything? I don't know. I did play a game of speed chess right before the show and I won. So there's something. Maybe I could just play more chess. The problem is that, frankly, there's not a whole lot we can do. I do think as investors, there are things we can do, although they're frankly not much different than I think we should be doing anyway, all the time, pretty much. I asked, and this relates to the poll question that I put up there about if you've ever been to a free retirement or investing seminar like a steakhouse. I went to one last, let's see, I don't even remember what day it was. It was last Thursday, I think. And I'm not going to talk a lot about it tonight. I'm going to do a separate video that I'm going to put out later this week on how I ended up there. It's the first one I've ever been to. The food was good, by the way. How I ended up there, why I was there, and the what happened. I will tell you that I disagreed with just about everything that came out of the person's mouth that was making this presentation. And if I had to sum it up, and this relates to this whole downgrade and debt issue, if I had to sum it up, it was this, that this person and their firm were recommending almost at every issue that they brought up. They were doing a couple of things. Again, I'll go into more detail in the video later this week. But one, they were using our fear, so fear of market volatility, fear of inflation, fear of rising interest rates, fear of just instability in our government or whatnot, or in some cases, fear of missing out. But it was mainly fear of loss, not fear of not having some gain. And they were using that to promote investing products that had two features. They were complex and they were expensive. Their solution to all of these fears were investing options, like think an option strategy, for example, or a complicated individual stock or bond portfolio rather than funds. They wanted to promote a complex solution that was very expensive. And it really struck me as how that is maybe one of the biggest hurdles that a lot of folks, particularly as you get near retirement and into retirement, really need to overcome. That fear that leads you to complex, expensive investment products. It is I think maybe the single biggest problem that retirees face who are managing some portfolio. And I worry that folks that sell these complex, expensive products will use things like the Moody's downgrade and our growing debt, which are real issues, but they'll use them to just promote and sell more complex, expensive solutions. And every year that goes by, I get more and more and more convinced that we need to simplify as much as we can our portfolios and keep fees down, and that we can address the challenges at least as well as one can address them through that simple, low-cost approach. And I think that's true when we think about our country and its future and its deficits and its debt. For example, one thing, and I've talked about this, you guys probably get tired of hearing it, diversification. That's why I've never been a fan of a 100% U.S. stock portfolio. And I know others have, and people a lot smarter than I am when it comes to investing, like Buffett and Bogle. Although I wonder, if they're sort of coming from a very different perspective, or were coming from a different perspective in the case of Jack Bogle than maybe a lot of us. I don't know, but diversity. Excuse me, I'm getting choked up. So, and it's diversity not only on the equity side, but on the fixed income. That's why I like a combination of regular bonds and TIPS, for example. Some have emailed me recently and said, should we have international bonds? I feel less strongly about that. That's maybe a whole nother topic, but I certainly don't think there's it's not a mistake to have an international bond fund. Vanguard has one that I think is good. And a lot of the balanced funds that Vanguard offers include an exposure to international bonds. I don't see any issue with that at all. But diversity for me is probably the single most important approach to dealing with country-specific uncertainties. Now, of course, for those of us that, most of us live in the U.S., we can't get away from the issues that confront us. I guess we could move out of the country, but short of that, you can't run away from the issues that can confront us. And I think eventually we will be forced to deal with them as the interest payments get bigger and bigger and bigger as a share of the revenue that the U.S. government brings in, as a share of our budget. I just, trees don't grow to the sky. Deficits can't just go on forever. So eventually, we're going to have to make some tough choices, and it won't be easy. And it's going to be difficult to know when that's going to happen and exactly how it's going to play out. I think, I listen to a lot of pundits that claim to know that, and I basically just ignore them because the reality is nobody knows. We just don't know. I think we'll see small changes until we see really quick, big changes, which is often how these things happen. And when that will happen, I have no idea. But I think diversity is probably one of the important pillars of dealing with not just this, but a lot of the uncertainty that we face. And diversity is cheap. Nickels and dimes shouldn't cost us much at all. We don't need fancy, complex, expensive investment strategies to diversify. We don't need a lot of funds. You can do it in one, really, if you want, some sort of like a life strategy fund or some balanced fund or even a target date retirement fund. You can do it with a couple of funds, but very, very, very easy. I will say from a tactical perspective, the one thing that I'm absolutely going to be doing this year are some Roth conversions. And I'll probably do Roth conversions every year for the foreseeable future. I'm not one to predict future tax rates, but it's hard for me to see, even if I'm at the same tax bracket, which right now, I think the bracket I'm in now, my wife and I are in, will likely be the bracket we're in, say, when RMDs kick in. Now, whether that bracket is the same percent, I don't know. Obviously the government could raise it, or it's hard to imagine they'd lower it, but I guess anything's possible. But even if that's true, we stay at the same bracket, the Roth conversion is going to make all kinds of sense, right? Because we're going to pay the tax from outside our IRAs or 401ks, and therefore we get a benefit the longer we keep the money in the IRA. And we haven't even thought about things like IRMA and Social Security, tax on Social Security. So I think it's sort of a no-brainer. My specific approach on that, by the way, is actually not to use all the tools I talk about. I mean, I use them to get an idea, but at the end of the day, what I'm going to do, I think this year, is any excess income we have available when we get to I'll probably wait till December. Let's say we've got $10,000 that we can spend on taxes from the conversion. We'll just assume our tax rate's 25%. We'd convert 40,000, and I'll invest that cash in paying for the conversion. So that's how I'm thinking about it right now. Any excess cash will go to Roth conversions, and that's a tactical approach. It's not even specific to what happened over the weekend or with Moody's downgrade. It's just generally my view of where taxes are headed, and even if they stay where they are, it still probably makes sense to do it. So anyway, that's my take on everything. Which is to say, I'm not really doing much of anything. For me, it's steady as she goes, because what am I going to do? I don't have any good, some will say, well, inflation, maybe you need gold, maybe you need commodities, maybe you need real estate. I have exposure to all of those things through total market index funds. I guess the question is, should I have some increased exposure? For me, the answer is no right now. I'm not wedded to that. I'm not necessarily opposed to, say, having a little more in real estate or something. But I don't see a need to do it now. 14% of you have been to a free dinner retirement seminar. If you could put in the comments to the extent you care to share, like, I don't know, did you find it helpful? Not helpful? Did you hire the person? I don't know if you want to share all that. I'll tell you again, I'll do the video and walk you through the story later this week. But I will say one thing among many that troubled me was that it was sort of presented as this educational talk, which is one of the reasons I went in the first place, and it just wasn't. It was a sales pitch, and what troubled me was that they really hid the fact that it was a sales pitch. I mean, they really did try to present it like this is just educational content, and it was very subtle. And if you're not well versed in a lot of these things, and by the way, I don't pretend to have all the answers, but I mean, I've been thinking about these issues long enough. I'll just give you one taste of this. The guy says that actively managed mutual funds, they do better than index funds 50% of the time. It's 50-50. Well, it's just not. We have the studies. It's not 50-50. That's just it's just wrong. Now, I don't know. Maybe he made a mistake. Maybe he honestly believes what he said. I'm not, I don't know that, but I mean, that was just a minor point in the evening. It was, it was not good. I'll share more about that. I want to do it in a separate video because I'm hoping a lot of people see it as a sort of self-contained video. And by the way, it goes beyond, I know I'm starting to preach now, it goes beyond the free dinner seminar kind of marketing tool that a lot of advisors or some advisors use. The strategies that he was using to try to convince folks, hey, these complex, expensive strategies are the way to go. You're going to hear them in the news. You're going to hear them, when advisors promote their practices. Not all advisors, of course. There are many that don't believe in a lot in this and take a low cost, simple approach. But a lot of them don't. And so you're going to hear this whether you ever go to a free dinner seminar or not. So, all right, enough of that chit chat. Let's get to your questions. I'll end this poll. I'll leave it up a little bit longer. I did see one question. I don't know if I can highlight it, but I think Dave asked it. Anyway, the question was, it was specific to Empower, but it's a broader issue. In fact, I was looking at this article here, the Wall Street Journal. There's going to be private market, private equity, maybe private credit, I don't know, investments apparently available in a 401k. I have to be honest, I haven't read any of the history here, but the SEC's job is to protect investors, period. And I can't fathom how this protects investors. It makes me question the motivations behind this sort of thing. But again, I've not studied their comments on this. They're being the SEC, the commissioners. I think private credit, private equity, private REITs are, again, it's the kind of complexity and fees that you just don't need. There's absolutely, someone might argue that there's a diversification benefit. I'm very skeptical of that. First of all, one of the big issues, and again, I don't have any specific investments in mind here, but a private investment, right, it's not public, right? That's why they call it private. So there's not a public market for it. So how do you value it? That's a real problem. And so a lot of what appears to be more stable returns and maybe some diversity really comes down to a poor methodology for valuing these investments. But I am not a fan of the complexity and cost associated with these private investments. I have no interest in them myself. Maybe you do, I don't know. But I'm not going to invest in them. All right, Peter, if 2 years from retirement and you have a pension that covers 70% of expenses, well, first of all, congratulations. That's wonderful. Thought on how much money to keep in safe assets like short-term bonds and cash to avoid sequence of returns risk. Well, so here's how I think about it. Question one for me would be, all right, how much money, actual dollars, do I need from my investments? It's 30% of my expenses. I don't know what that is in your case, but let's say I need, I don't know, $3,000 a month or $30,000 a year, whatever it is. And then what percentage of that, what's the percentage of that compared to my overall portfolio? And to me, that's what's going to drive, at least initially, my asset allocation, particularly between stocks and bonds. And I'll just include in bonds some amount of cash. So again, if I'm going to need 4 to 5%, let's say, I'm probably going to want to be 65 to 70% equities for me. Bill Bingen, his research put it at 50 to 75% in his 1994 paper that gave us the 4% rule. In later papers, he kind of zeroed in on the mid 60s. There's a trade-off there. One of the things he said in his 94 paper was, get as close to 75% in equities as you're comfortable. Part of the reason was, there's this whole thing of having your money last so you don't run out of money, obviously a very important issue. But it's not the only issue, at least for a lot of people. A lot of, the other issue is simply, well, how much money am I going to have? I want to leave money to my children maybe, or to charities. And so I do care about, the overall performance of my portfolio beyond just paying the bills, as important as that is. And I think that's why he, in his original paper, said, try to get as close to 75% as you're comfortable. But that's how I think about it. Now, if you said, well, Rob, 30% of my expenses, I only need 20 grand a year and I got $1 million portfolio. Well, at least if we're going to use history, you could invest it in terms of stocks versus bonds and just about any way you want to, because your withdrawal rate is so low. For me, I would definitely be at the 75% level. One could even argue a little higher if you only need 1 or 2% of your portfolio each year. But again, those are just broad strokes. There could be countless specific issues that might cause you to change that, lower it, raise it, and so on. So, obviously, we haven't mentioned age. So the estimated length of your retirement obviously going to be pretty important too. Bill Bingen was assuming a 30-year retirement. So a lot of other factors to consider, but conceptually, that's how I look at it. All in this poll, 15% said yes. Again, I'll go back through the comments later, but I'd love to hear your thoughts on that. I kind of got there by accident. I'll share the story in the video. Oh, okay. John wants to know, with 20 or 30-year treasuries approaching 5%, is now the time to lock in these rates, or will they go higher? So, John, let me tell you a story. It's 1982. I'm in high school. I have some money to invest, and I put it in a 6-month certificate of deposit at a local bank in Ohio. And I actually have the paperwork on this CD somewhere. Anyway, I was earning 16%. 16%, FDIC insured. Now, one question that might come from that is, Rob, 16% FDIC insured, and it's only a 6-month CD? I mean, what? Did they not have 5-year CDs back then? I mean, that was a long time ago. Did they have color TV? I'm not sure. They did have 5-year CDs. Why wouldn't I invest in a 5-year CD? Because we were concerned that interest rates were going to go higher. That may seem silly today with today's rates, and the rates we've had over the past decade have obviously gone up here last couple of years. But we were not scared to death, but the risk was rates will go higher. And the reason we were nervous, maybe is a better word, about that, is that we just come out of the 70s and into the early 80s, and interest rates, inflation, double digits, long lines at gas stations. There were some good things at that time, by the way. For example, getting like Pepsi in a glass bottle. I mean, cold on a summer day, nothing better than that. But yeah, there was a lot of angst. And so we were worried that rates would just go higher. And of course, they peaked and then they went down, and they've come down, more or less for how many years has that been now? 40? More than 40. Wow. So, John, that's the long answer to your question. The short answer is I have no earthly idea. So let's pretend that none of us have any clue what the future of interest rates look like. We may have opinions, whatever, but we really don't know. And no one else does. Jim Cramer, trust me, he certainly doesn't know. Warren Buffett, he doesn't know. No one knows. So now what do? You got to make a decision. I mean, even if you choose to stick your money under a mattress and not invest it in anything, you're making a decision, right? You have to make a decision without knowing whether 20 and 30-year treasuries, which are now approaching 5%, whether those yields are going to go higher or lower. So what do you do? And, my answer to that is diversify. There's different ways to do it. The B&D, if you look at B&D, which is the Vanguard fund, it's an intermediate term bond fund, but let me pull it up for a second. That's its sort of average, right? It's kind of like saying VTI, Vanguard's Total Stock Market Index Fund, is on average a large cap fund. On average, the value of companies are, large companies, but it owns a lot of small companies too. And if we go to B&D, I'll pull this up on the screen. And we go to portfolio, we can see the average or effective duration is 5.85. That's actually come down, by the way. One thing to keep in mind about duration. So duration is sort of the weighted average time it's going to take to get all of your money back from a bond. If you're a bond trader, you may bristle at that definition, but I think it works for our purposes. And so when you think about a bond, how are you getting your money back? Well, you're getting interest typically every 6 months during the life of the bond. And then at the end, whenever it matures, you get the principal back, right? So the point is, so what's that mean? So let's take a zero coupon bond. That is to say, a bond that doesn't pay any interest. You just get the end. Let's say you buy it for 800 and it's got a par value of 1,000. And after 2 years, I'm just making numbers up, you get the full 1,000 back. In that scenario, because you're not getting any interest payments along the way, the duration and the maturity are the same because you get all your money back at the end of year 2 in that example, or year 10 or whatever. But if you're getting interest payments, that's going to shorten the duration relative to the maturity because you're getting some amount of money along the way. And that raises the question, well, I guess how much are you getting along the way, right? If you're getting bigger payments along the way, that's going to shorten the duration even more compared to the maturity. So what's going to cause us to get more payments along the way? A higher yield. So yields are higher today than they were when I started this YouTube channel. If we went back in time and looked at this page 4 years ago, this would be higher. I don't know what it was. I may try to figure that out, but in any event, all right, enough of that. So what am I looking for here? What are we doing here? Let's coupon range. So we can see, these are years, right? 0 to 2 years. And you can see there's a lot in the middle, but there's some short term, 18%, 0 to 2 years in this. You've even got 6 to 8 here. You don't have long term. So if you wanted exposure to long-term bond, I don't personally feel a need to do that. You'd need another fund or add a fund, but you've got a fair amount of diversity here. And yeah, that's sort of my approach because, John, I don't have a clue what rates are going to do. All right. I'm kind of fired up today. I don't really know why. I was in DC yesterday and someone stopped me on the street and said, "Hey, do you have a YouTube channel?" I said, "I do." We chatted for a few minutes. He was very kind. So far, everyone that identified me out in the wild has been very nice. I'm glad. All right. Remember to tag me if you've got a question for me. Oh, this is a fun question from Josh. I asked Perplexity AI to plan a withdrawal strategy and Roth conversions based on my inputs, and it looked really good. Do you think AI will replace Boldin and ProjectionLab in the future? Well, I certainly think AI, artificial intelligence, large language models, will become an important part of financial planning. Absolutely. What I would like to see, and I mentioned this to both Boldin and ProjectionLab a couple of months ago, and Kubera offers this. I've not tested it. Kubera, Kubera, is an app. It's, I don't know, $100 a year, but you can track your portfolio and your net worth. I suspect most of you would prefer Empower over Kubera because Empower's graphics are a lot better and it's free. And I don't know that Kubera does much that Empower doesn't do. But I really like the simplicity of the layout in Cubera. I don't think I can show it to you, but well, hang on. Maybe I can. Maybe I can. Let's see. I don't know. No, I can't. My mother-in-law could be watching, but in any event, what was I saying? Yes. So what you can, I've not tested this yet. I'm a little nervous about it, but you can, they have a feature where you can connect it to ChatGPT. And this is the part that makes me nervous. It gives ChatGPT effectively access to your portfolio, not access in the sense of your brokerage account, but I mean to the data. And then you can query it. You can ask questions to ChatGPT. And I will test it at some point. But that's what I would like to see with Boldin and ProjectionLab and these other tools, is to say, here's all of my data. Now I want to ask you questions about that data. And that strikes me as something that should be, I'm not an engineer, but should be fairly straightforward to implement, I would think. I think Boldin has implemented AI, and in fact, I can show you, in terms of help using the software. I think I can show you this. No, I can't. That's okay. Right now, I find myself, when I have a question about an app, going to ChatGPT, I don't go to the app's documentation. I just go to ChatGPT and or Claude, and they've gotten remarkably good at answering these questions and walking you through. I had a question about Final Cut Pro, which is the software I use. I don't edit my videos, but I have to do a few things to them, mainly cut off the beginning and the end, before I upload them. And I had a question about something, and it walked me through step by step. And, unlike a search engine, when it gives me a step and I don't understand it, or I can't find what they're talking about in the app, I can ask a follow-up question. Really good. And I'm pretty sure Boldin does that. I know Boldin does it. I wish I could show it to you tonight, but it's fine. If you're using Boldin, you'll see it. I don't know if ProjectionLab does, but they should be able to get to a point, I would think, quickly where you could, it could be maybe some privacy issues, maybe, I don't know, but where you could query ChatGPT or another AI model about your plan with your data. That seems to me like at a minimum, Josh, that should be happening. Where we'll go beyond that, I don't know. Maybe one of you will come up with a great app and share it with the rest of us. All right. By the way, I've heard some talk, about, well, does this mean Moody's downgrade? Does this mean the U.S. is going to default on their debt? It's got nothing to do with that. Nothing's changed, or everything has changed slowly, but it wasn't as if something happened. I mean, when you look at Moody's, it's kind of like a culmination of a lot of things, and they were the last major, rating agency to downgrade the U.S., I think. But this isn't about the U.S. making its interest payments. And by the way, we borrow in U.S. dollars, and they control the printing presses, so it's not really about that. At least it isn't right now. Not as far as I can tell. Okay. Jonathan says, I went to this seminar as a reporter, not a potential client. Well, I was certainly not a potential client, but I was hoping to learn something because it was what caught my attention was it was this topic was how to deal with volatility. Well, what a great topic. Particularly, I mean, all the folks there were like my age or older, as far as I could tell. And, it's an important topic to a lot, at any age, but particularly as you get near and enter retirement. And I learned nothing other than probably won't go back to a free dinner seminar. Anyway. Jamie says that he and his wife have attended half a dozen. Turned them all down. The food was top notch. The food was excellent, actually. I had salmon and mashed potatoes and grilled asparagus. And I tend to try to avoid sugar, but the cheesecake was fabulous. All right. Ponderosa. Wonder if Rob went to Ponderosa for the free steak. Oh, I have fond memories of Ponderosa as a kid in Ohio. And that was when a night at Ponderosa, that was a big deal. That and Red Lobster. Didn't happen very often. Kat says, I hope you left your wife at home. Trust me. She wouldn't, you couldn't have paid her to go. She had no interest in going. All right. I don't know here. Do you know of any exclusive tax planning service? I don't need financial investment planning, just tax. I mean, I would just go to a tax accountant. I mean, if you have something specific in mind related to retirement or something else, find someone that's got experience with that. Yeah, and you do have to find the right person, because there are plenty of accountants out there that just want to do returns, or tax folks that just want to do returns as opposed to a lot of planning. But I don't know. I mean, I don't have anyone to recommend that does that. All right. You guys really want details. What was the restaurant where they held the retirement discussion you attended? It was not the Ponderosa. It was, let me make sure I've got the name right, because it's not far from where I live, but I'd never heard of it. Yeah, 801 Chop House. That's the name. 801. That's in the name. I don't know. Is that a thing? You know what I did? I changed my default search engine to ChatGPT, and I'm kind of regretting that. I love ChatGPT, but not as a default search engine. I need to change that back. I don't know if this is a single location or... Oh, no, they're all over the place. Minneapolis, Kansas City, Omaha. I wonder if Warren Buffett's been there. Well, they don't have that many locations, but yeah. That's where I was. It was funny. I thought it was funny. I was sitting, next to some lovely people that I got to meet, and there was a gentleman to my right, and he was talking about a robo-advisor and their portfolio. And, I don't study these things daily, but I've looked at them a lot over the years. And I said, oh, yeah. And started talking about some specifics about that particular robo-advisor. And he looked at me, he goes, I'm kind of surprised you know that. I said, yeah, it's a party trick I have. I don't know. All right. Well, here we go. Portfolio question from Braxel. What do you think of a portfolio with VTI? So it's a Vanguard Total Stock Fund, U.S. Stock Fund. BRK, which is Berkshire Hathaway, which I kind of view for the most part as a large U.S. market cap mutual fund in a way. It has some distinct advantages, I think, over just a typical mutual fund or ETF, beyond the fact that, a guy named Warren Buffett works there. One of the challenges in a business, and I'll get back to the portfolio, but you imagine you've got a great business. You're it's a public company, whatever, and it's making a lot of money. You got all this cash, and you have to figure out, what am I going to do with the cash? Now, you can always give it back to shareholders, either by paying a dividend or buying back stock or some combination. So that's an option. You can invest back into your business in a variety of ways, by expanding, research and development, maybe some acquisitions. But when you invest back in, there's always this question, well, if I put this $100 million, whatever it is, back into this business, what's my return going to be? What's my return on this invested capital? I mean, maybe before I put that 100 million in, maybe we've got a good return on capital and we're getting back 20% or whatever. But can I keep doing that? I mean, maybe if I invest this 100 million, I might do okay, but I'm not going to do 20%. There may be a limit to how much money I can invest back into this business and get the returns I want. And if that's the case, if I'm going to do the right thing by shareholders, I probably need to give it back to them in one way or another. But boy, wouldn't it be great if I didn't have to do that? And investors should love that too. But what they don't typically do is say, okay, well, you know what I'll do? I'll take this 100 million and I'll put it in a totally different kind of business, not the one we've been running for 75 years, whatever the case may be. That usually doesn't work out so well, except with Berkshire, that's exactly what they do. They've got plenty of fully owned businesses, right? Railroad, energy, insurance, Dairy Queen, See's Candy. And a lot of these companies might do great with the capital they have, but they just don't have a lot of need for more capital. So they might produce all of this cash, but putting it back into the business that produced it, probably not the smartest investment. But that's okay, because the way this company is set up, they can invest in shares of partial ownership of great companies. They've got a setup where they can, when the acquisitions are there, buy a whole company and let it continue to run independently. And so a lot of advantages to Berkshire Hathaway, in my view, for whatever that's worth. SCHD, which would be a value fund, it's a dividend fund. VXUS, and by the way, I own, so I look at this, I own, I guess now maybe indirectly, all of these funds. I own all of them. VXUS is an international stock fund and B&D is a bond fund. I think that makes a perfectly brilliant portfolio. Love it. How would I allocate it? Well, the first question would be stocks versus bonds. I would add probably tips to this, but how much you're going to put in stocks and bonds. And in terms of the stock portion, for me, I would put 20% or so in VXUS. It's as much art as science. I'm not quibbling with, someone could say, well, I want 30%. Okay. I don't, as between SCHD and VTI, I would probably, I don't know how much I would tilt that portfolio. I probably wouldn't put more than 10% in SCHD. And in terms of Berkshire, it depends. Part of it depends on asset location. So like if I have retirement accounts, I might throw VTI in it. And if I have taxable accounts, I might put BRK in it. And so the percentages there could be driven as much by taxes. As much. So anyway, that's my quick thoughts. Obviously not specific numbers because, it's going to vary, but I like those. I liked all of those investments. Okay. Just B wants to know if there's a difference in owning corporate bonds, whether or government bonds, and TIPS. Well, technically TIPS is a government bond, right? But I get what you mean. Yeah, there's a big difference, huge difference. Corporate bonds and I'll just say regular nominal U.S. bonds don't have any built-in inflation protection, right? You get an interest rate, coupon rate. So you buy a 30-year bond and it's yielding 5%. Let's just talk about that briefly. you're probably buying this bond from an investor, not directly from the government. You go into Treasury Direct, I guess. And so when we say the yield is 5%, understand that's not the interest rate you're getting on the bond. And I know this can be a little confusing, but bear with me because I think it's important. I'll just make up numbers. Let's say the government's paying a 3% coupon. So it's $1,000 bond, and you're going to get 3% of that every year. You divide it up. Usually, I think there may be exceptions, but every 6 months you get a payment. And so you're going to get 3% of $1,000. Well, how does that translate to a 5% yield? Here's the trick. When you bought that bond, you didn't pay $1,000 for it. You paid something less. And I'll just make up the number. There's, you can do the math and figure it out. But let's just say you paid $900 for the $1,000 bond. And when you take the interest you're getting and you divide it by the $900 that you paid for it, that gets you your 5% yield, or whatever the number turns out to be. Now you might say, well, Rob, this is my first time listening to your show, and this ain't making much sense. Why would someone sell me a $1,000 bond for just $900? And the answer would be because it's only paying 3%, and the going rate for a brand new bond is 5%. So unless they discount that bond by enough so that you get that 5% yield, you'd never buy it. You just go buy a new one. And so they have to discount it to get you to buy it. And that gets you to your 5% yield. But anyway, it's your typical bond. With TIPS, TIPS have a built-in inflation adjustment. So as we experience inflation, the government takes the $1,000 bond you bought and increases that amount by the rate of inflation. So if inflation's 2%, congratulations, you've now got $1,020. I think that's right. And what happens, two things happen with that. The first is, as it calculates the interest it owes you based on whatever the interest rate is, the coupon rate, it will multiply that interest rate against that new number, that 1,020. And then at the end of the term of the bond, many years down the road, as it's gone up each year, assuming we have inflation, and it's at, let's just say it's at $1,200, you've been getting more and more interest each year because the interest rate, which is fixed, but it's being multiplied against a higher bond amount because of these inflation adjustments. When you get to the end, when the bond matures, you get that higher amount back, that $1,200. And so that's how inflation is sort of built into TIPS. And the only other thing I would add is that you think, well, that seems like a good deal. It is, but you pay for it. There's a cost. That you could think of that as sort of an insurance policy. And I know many of you that have watched for a long time have heard this spiel before, but it's an insurance policy. And insurance costs money, and you have to pay for that policy. How do you pay for it? You get a lower interest rate. And you can see the spread, the difference between, say, a 10-year regular nominal U.S. government bond and a 10-year TIPS. We can look it up. It's usually, I don't know. Oh, well, we're going to let ChatGPT. I got to change the default search engine. It's slow. 10-year TIPS spread. We should get the Fred. They call it the break even. Here it is. And so right now it's around, I'm guessing 2, I don't know, 236. And what that means, among other things, that's the difference in the yield, but it's also the market's estimate of what inflation will be over the next 10 years. And you feel free to disagree with that. Yeah, ChatGPT eventually got the right answer, 236. Yeah. All right. Well, here's a nice comment from Vibe with Money. Just found your channel in the past couple of weeks. Bought your book. Read it yesterday. Loved it. Learning a ton from all your videos. Thanks for what you do. Well, I appreciate that. It makes me smile. So at the gym I go to, one of the trainers, his name's Paxton. This guy is a beast. I would not want to confront this guy in a dark alley. he bought my book as a sleeping aid, and apparently it's working wonders. I thought if that catches on, because there's a lot of people that have trouble sleeping. If it catches on, I could sell millions of copies. So this is, I think, in context of this free dinner. John says usually they soft sell. So it was a very soft sell. There's no sign on the dotted line. You have till midnight, nothing. In fact, well, I'll save it for the video, but their strategy was interesting. Kat says, Rob, if you had an educational talk, I would come for dinner. That's funny. I don't know if this is ever going to happen, but I think, should we have a meetup, like plan something? But I think, I don't know. We got the Bogleheads. Do we need another meetup? Let's see. Dave wants to know if I was quietly enjoying my meal or did I ask the presenter questions? More the former. I asked one question on a ridiculous option strategy that they were pursuing. I'll cover this, but I just have to tell you this. The option strategy was to sell puts on margin. So a put, if I sell a put, I sell to another investor the right to sell me an investment at a certain price. So let's say I have shares of, it's on shares of the S&P 500 ETF. Let's say they're trading at $100. I could sell a put with a strike price of 90 that says to the buyer, hey, buyer, at any time during this option until it expires, let's say it expires in a month, and anytime over the next 30 days, you can sell me shares of VU for $90. It's currently trading at 100. And you say, well, you might be saying, well, Rob, why would anyone, they're not going to obviously sell you something that's trading at 100 for $90. Why? Doesn't make any sense. And they're paying you a premium? Right. So what they're doing, well, let me back up before I tell you what they're doing. The presenter described the buyer of this put as a gambler. This is the folks that like to go to casinos. They're gambling. And what we're doing, we're collecting the premium and we're just sort of raking in the income. We're not gamblers. And it's the exact opposite. The buyer of the put is gambling very little. Their potential loss is the cost of the option. That's it. It's capped. Our loss, well, it could be devastating depending on what happens over the next 30 days with the S&P 500. And you might say, okay, so they're buying insurance in case the market drops. Exactly. That's what they're doing. But come on, Rob, 10%. It happens, but in 30 days. And that's the problem. Whether you're selling calls or puts, you think you're generating some income. It can work for a long time, particularly if you're selling out of the money, calls and puts, that give you a decent cushion. And they're on the shorter time frame in terms of when they expire. You can make nickels and dimes for a long time. And then it just takes 1 month and you get absolutely crushed. Absolutely crushed. And you're doing that on margin? All right. Anyway. All right. So this is an interesting question, but I'm probably not the person to answer. What are your thoughts on a portfolio for retiring, moving outside of the U.S.? How do Forex rates affect my portfolio? And is there any strategy adjustment that is recommended? It's a great question. Obviously, a big part of that is where you're moving to and what currency you'll be spending in retirement. And I'm sure there are ways to deal with that depending on where you're going, but it's just not something I've had to address. So I am not the person to answer that question, but I put it up there. Maybe someone in the chat has some experience with it. All right. What's this? This is funny. Can you close the top cabinet door behind you? It's driving my wife crazy. I guess it's this one. Hang on. This? That's as good as it gets. Watch the whole thing fall down. A lot of people, I've got a lot of emails lately about this guy. Let's see if I can get it to focus. It's kind of, there we go. ROM. Space Knight. I was not a huge comic book collector, but for some reason, ROM really, I like Spider-Man was probably my favorite, but ROM really resonated with me. And, you know, it's not as well known, but at one point I owned all of them. And I ended up selling those and the other comic books I had when I went to law school. And I was at a comic book show and saw that. It's not a particularly valuable comic. I think I paid $100 for it. It's a lot for a comic book, but it kind of reminds me of my youth. All right. Here's an interesting question from Leslie. Can Roth IRAs from various sources be combined? I believe so. I'm not aware of any limitations. Again, you want to verify that. Don't take my word for it. But you know, if you have to keep all the paperwork though for all the different things you've done, and some of them might have some tax filing documents with them, depending on what you're doing. Because when you pull the money out, and depending on when you take it out, it may not matter eventually. But you know, you're deemed, whether you combine them or not, and regardless of which Roth IRA you withdraw from, you're deemed to take out contributions first, which is good, right? Because they're not taxed and no penalties regardless of when you take them out. But you have to think about the ordering that way. But I'm not aware of any limitations. Of course, as soon as I say that, and then I think, well, it's tricky business. So you want to confirm that. All right. You know what I think I might do next week or 2 weeks from now? Noreen and Matt, who are both, I assume, well, I know I've seen Noreen in the chat. I might set them up on Slack so that they can cut and paste questions for me into Slack that they want me to answer, you know, that you guys are asking. And then rather than having to scroll through the chat, which is fun, I admit, but it's time consuming, I can just pick up the questions from Slack. Although if I did that, I wouldn't be able to show them on the screen. So there's that. Noreen says it'd be fun to run into me in the wild. It's amazing how many people. I mean, I've run into people in New York City on the street, Philadelphia, here in Virginia, in an airport. Where was I? I don't even remember where I was. Atlanta, I think. It's fun. Okay. So what do I think about SCHD? I mean, I own shares of it. I like the fund. I don't know that I would heavily tilt my portfolio to this kind of investment. I prefer just to stay sort of total market. But I own this in some Roth accounts. This is the fund. And my reason for it has nothing to do with the dividend. And in fact, it may not have even been the best investment for me, but it's fine. I wanted a value tilted investment because of valuations. So if you look at the portfolio, well, it's deep value. It's got a price to earnings of 13.5. If you compare that to VU, which is an S&P 500, it's 21. So, I mean, it's a big difference. And of course, price to book is higher, price to sales. So that's why I bought it. I don't own a lot of it because we don't have large Roth accounts, I'm sorry to say. All right. So from John, recently retired in my 50s, surprised that Boldin doesn't model a more dynamic withdrawal order. Pre-post 59.5 years old. Can't really model future account values. Agree? So you can modify the withdrawal order. But you're right. I don't think you can say, well, between now and 59.5, use this withdrawal order. And then at 59, once I reach the age of taking out withdrawals without penalty, change the withdrawal order. But you might be able to get there, something close. It depends what you're trying to do. So if before you're 59.5, let's just assume you want to take money out of a taxable account. You could do that. Let me see if I can show this. Bear with me. I don't think I'm going to be able to log in from here. One more time. If it doesn't work, I'm done. No, I don't know. I can't show you. But in any event, I can describe it. So, you could, you don't have to have accounts in Boldin that are one-to-one with real life accounts, right? So you could take your taxable accounts and divide them up. You might have one brokerage account, but you could divide it into as many, well, there might be some limit, but as many accounts in Boldin as you want to. And you could have one account that you think is going to be enough to get you to 59.5. It's a taxable account, assuming that's where you're pulling your money from. And I'm trying to think this through. That could get you to 59.5. And then you could change the order to something else, I think. And I'm aggravated. I can't log into my Boldin account. The problem is it's the demo account. I just don't have the password on me. So I have to look at that. There's got to be a way, John, to get close enough. I believe that with the customized withdrawal order. But I'll look at that. Maybe in 2 weeks I'll come back to that. Or for a 5-question Friday, maybe I'll throw it in there. All right. Look at this. Nicholas, I was the guy that said hi to you in DC. Thanks for doing what you do. Appreciate it. That was just last night. That's funny. All right. How do I deal with volatility? Well, diversity is certainly part of it. But the way I deal with volatility the primary way is, when we think about dealing with volatility, particularly if you're an advisor wanting to sell a product, you often ask, okay, what can we add to your portfolio to deal with volatility? So some complex option strategy. They mentioned direct indexing, which I think is a silly way to deal with volatility. But what they don't often talk about are things that you can do that have nothing to do directly with your portfolio. So, for example, keeping your debt low, maybe working a little bit longer. I know that's not an option that everyone wants or can do, and it doesn't necessarily mean full time. But there are things you can do outside your portfolio that, at least that I do, that help me manage the volatility. For me, keeping out of debt is probably the biggest one. Again, if you have debt, this is not something you can just snap your fingers and overnight deal with. It's, but all the more reason to get started now, right? Because it's going to take some time. But to me, it's these sorts of approaches that help me the most deal with volatility. Some of it is, I guess, years of investing, although that's a little tricky because there's part of me that's gotten less or more conservative as I've gotten older. And, I look at our country, you get to my age and it's, as you get older, there's just something about the world that tells you things aren't like they used to be. That things aren't as good as they used to be. The kids today don't understand what it's like on a Sunday afternoon to only have Hee Haw and the Lawrence Welk Show to watch. Those were the only options. They just don't get it. They don't understand. They don't understand what it was like. That was actually a bad part of 40 years ago. But in some ways, it's gotten maybe a little harder to deal with volatility as I've gotten older. But the net of it is no, because of these things outside of my portfolio. I can diversify, and I have. I keep my costs low. Can you imagine volatility and you're paying someone 2% of assets under management? That to me is a bad combo. But the best ways, I think, are, once you've diversified, are things outside the portfolio. The other thing I do, I haven't done this in as much detail as I once did, was I imagined a doomsday scenario. This was before I retired, still working. And I thought, okay, investments get cut in half, real estate gets cut in half in value, and I lose my job for a year. Can we survive? What will that look like? How much can I cut back on our spending without doing something really dramatic, like selling the house and moving? I could do that too, by the way. That was part of my doomsday planning. But short of that, I started going through it. Well, we can get rid of a car, particularly if I'm not working. Don't need two cars. Get rid of a car, do this, that, and the other thing. And, when you look at the numbers, you think, I came to the conclusion, it would not be a happy time, but we'd survive. We'd figure it out. We could get there. So that helps me too, imagining the worst. Now, of course, you could say, well, Rob, it could actually get worse than that. Yeah, that's true. If that happens, then I don't know. Mindy wants to know, with Boldin, can you assign a different rate of return assumption in each ETF account when you import your bank investments into Boldin? Well, if you import them in, I think they come in at the account level. So if you own 5 ETFs, they come in at the account level. Now you could take a blended rate. You could say, okay, well, like in your portfolio, you've got some VU, SCHD, and BND. You could say, well, here's my asset allocation, and so I'm going to use a blended rate and just come up with a rate of return that way. If you don't import your accounts, which I don't, I just manually type them in, you could break them all up. You could have an account that just has VU in it and then have a rate of return. And you could have an account that just has BND in it, have a rate of return. I do that on the taxable side, not so much to deal with rates of return at that level of detail. I'm happy doing a blended rate. But I did it with different investments that have a higher unrealized gains, like our Apple stock, in part because I wanted to set the cost basis for that investment. And from a withdrawal order, I wanted to move it to the end because it would benefit the most from a step up in basis when we go to that great big mutual fund in the sky. Yeah. So yeah, you could do that. I really like manually entering the accounts. I mean, you update the numbers once a quarter, twice a year. It's very quick. So. Okay. Just B says there are still ponderosas in Ohio. I believe it. I don't think I've been to one in a very, very long time. I'm trying to cut down on the red meat, by the way. I'm kind of going Mediterranean. I had salmon tonight, salmon and grilled broccoli and a little bit of rice noodles. Normally, not normally, but a lot of times what I'll have is a quinoa lentil mix, which I actually enjoy. Yeah, I know. Yeah, I've been to that steakhouse. This was a decade ago. I didn't really care for it. It was okay. I didn't know I didn't get the draw to that, but all right. Oh, here we go. Here's a positive from David. I went to a presentation without food. There's your key. When my wife was deciding whether to start her Social Security benefits, it was not a sales pitch, just info on Social Security was very helpful. Yeah, the food costs them money. So when they're buying you a fancy dinner, it's marketing. All right. Let's see. BC wants to know if Monarch Money automatically syncs with your Fidelity CMA. Yeah, it does. Yep. The more I use Monarch, the more feature rich I realize it is. One of the things you can do, we don't do this, but if if there's two of you handling the budget, if you're going through it and you see a transaction, you don't know what it is, you can actually assign that transaction to your significant other to review, which I found kind of interesting. I'm not sure how my wife would react if I assigned her a transaction. Maybe I should try it and see what happens. If 2 weeks from now at 7 p.m., the show doesn't start, you know it didn't go well for me. Okay. Not sure I follow this, but I'll try. David, how does one start taking money from retirement funds for Roth conversions and for living expenses? Well, those are two different things, right? So if you're going to do a Roth conversion, you're simply transferring money from, let's say, an IRA to a Roth IRA. And you could talk to your broker wherever you keep your money. It's going to generate a tax form. But, I did that. I did it last year and I did it this year for a backdoor Roth. But I mean, it's still a conversion. For living expenses, you're just pulling the money out. I mean, in the case of probably for most brokers, you're going to have some sort of cash account. There was a mention of cash management account at Fidelity, which is very good. But if you're at Schwab or Vanguard or wherever, you're going to have a cash account. Well, they might. I see. I've not gotten to this point yet. There might be ways to spend it right out of an IRA. I don't know. I've not had to deal with that yet. But you can just withdraw it into a cash account and then either transfer it to a bank or however you're going to, whatever you're using for your spending account. So David, and I apologize if you were getting at something that I'm just too, I don't know, tired to understand, but that's my best answer. Jonathan wants to know, do they charge you capital gains tax when tips mature? I don't think it's capital gains tax, is it? I've only owned them I've never owned an individual tips. It's always been in a fund. And it's never been capital gains. Hang on. Let's ask ChatGPT. Well, according to ChatGPT, they can generate capital gains, but not tied to maturity. I suppose if interest rates went down and the value of the fund, let's say a fund or a TIPS bond, went up and you sold, that could generate capital gains. And and this makes the point that inflation adjustments are taxed in the year they happen, right? They're not. That's how you get that phantom income if it's in a taxable account. I like they put charts in here and everything. So I don't know if that answers your question. It's the best I got. Omar says, I've been obsessed with the Paul Merriman portfolio configurator. Let me look that up. Did I say Paul Newman or Paul Merriman? Paul Merriman portfolio configurator. Oh, here it is. I don't think I've looked at this. Oh, maybe I have. I have seen this. It's pretty fancy. I've not played with this, but I'll have to look into this more. Anyway, to answer your question, I mean, Avantis funds, I think have had a pretty good reputation. I was actually looking at one. I'll show you what I was looking at. It's this one. Their small cap value fund, which has done pretty well. I've not compared it to like a benchmark. And the reason I was looking at it was I was actually looking at individual companies that are in their portfolio. I find, I've spent some time looking at individual companies. One of them is Core Natural Resources. And the reason is because some value investors have bought into this and other coal companies. And I'm trying to figure out why. I still don't have an answer. But I think this has done well. I've not been persuaded to change funds, and I probably won't. But at least what I've seen with Avantis funds is that they've done pretty well. They're pretty good. But I've not compared them side by side to say just a Vanguard index fund. But I will take a closer look at Paul's configurator. Looks pretty good. All right. Rick says, just started watching your videos. Your content is very helpful. I've not started investing yet, just doing research. Any advice where to start? Well, there's certainly some books you could read. I think I've got them over at my other desk, but depends on what your specific goals are. But one book that I like a lot. Oh, it's going to put it up in ChatGPT. Hang on. I've really got to change the. Here we go. Oh, really? I'm having technical difficulties. this one, The Boglehead's Guide to Investing. That's a good general guide. I have it somewhere. Like I said, it might be on the other shelf. Oh no, here it is. Right here. I think this is as good an introduction to investing as you'll find. They have if you want something a little shorter, they have one on the 3-fund portfolio. I'll show you that one. Basically the same kind of cover. Here it is. I have this book as well. It's much shorter. This might be a good place to start. Can't go wrong. So there you go. So what is the best strategy for RMD withdrawals? Monthly to even out the ups and downs? I've not gotten to that point yet. Well, that's not true. I do get an RMD from an inherited IRA, but it's very, very, very small. And I just take it once a year. I find it hard. I'm hard pressed to feel strongly one way or another. Part of it might just be what cadence you want for your own budgeting. There's certainly nothing wrong with monthly. But at the end of the day, I guess one could argue that unless you need the money, wait as long as possible so that it stays invested. But of course, if you don't need the money, you're going to pull it out and then reinvest it in a taxable account, presumably, if you don't need to spend it. So Sharon, I find I'm hard pressed to feel strongly one way or another. Again, beyond just practical considerations in terms of when you need the money. All right. Oh, an asset location question from Gen X retiree. How would you allocate a portfolio that has 2/3? This is kind of like, two trains left stations traveling towards each other. Allocate a portfolio that has 2/3 of taxable brokerage assets and 1/3 Roth. Would you keep fixed income in Roth for tax purposes? I'd prefer not to, because I want it to grow. Part of it depends on my tax situation, and how comfortable I am with holding municipal bonds. I wouldn't want the whole fixed income portfolio to be in municipal bonds, though. So I guess at the end of the day, I might have some fixed income in a Roth account if the added taxable income from bonds caused me issues. I say it that way because, if it's going to trigger IRMA, for example, now you're Gen X. Are you Gen X, or is that? Yeah, you're Gen X retiree. So you're probably not at IRMA yet. But that would be a consideration. What tax bracket am I in? Is it going to put me into a new tax bracket? How's it eventually going to affect tax on Social Security? Is it affecting Affordable Care Act credits? I could see a situation where I'd be okay holding, say, Treasuries, no state income tax, if that's a factor for you. You may live in a state that doesn't tax income, but and maybe some municipal bonds, and I might be comfortable with that in my taxable account. So it really depends on the specific tax situation you're in. I try not to have taxes drive the decisions, but you can't ignore them either. So yeah, I would look at both scenarios. I wouldn't rule out having bonds in my taxable account or my Roth account. I think it just depends on your specific set of circumstances and your tax situation. Yeah. That's my best answer anyway. Noreen says she would attend a Rob meetup. Yeah, I have to think about that. I don't know. I'd need help organizing it. Like, who would we invite? I'll ask. Since we're getting near the end of the night, I'll do another. I should have done more polls, but I'll start one. Would you attend an annual meetup? Yeah, assuming you could, of course. Yes, no. I'm not sure. There we go. Then I think we'll do. We'd have to organize it to some degree. Obviously, should we invite some speakers? Who would we invite? I don't know. I'm not opposed to it. Can't believe it's almost 8:30. Do I think Chairman Powell will lower rates in light of credit downgrade? I don't think. I mean, of course, I don't know what he'll do or what he's thinking. I wouldn't think that the downgrade specifically would be a factor for him. The Fed has basically two goals, right? Keep inflation in check and keep people working. And those two goals can sometimes work at odds with each other. You overheat the economy, unemployment is really low, and it triggers inflation. So so you've got to cut interest rates, or raise interest rates to battle inflation, and that can trigger unemployment. And so it's sort of this seesaw back and forth. It can be. And then you have something like stagflation, where you have inflation but not a lot of growth. And now what do? And so I think that's what Powell and the Fed is looking at: inflation and unemployment. And there's this concept where you can get to neutral unemployment, where it's neither causing inflation or one way or the other, or deflation or lower prices. But that is always, it's almost impossible to know what that is in advance. You sort of know it after the fact. So, he's got probably one of the toughest jobs in the financial sector, in my view. But I think that's what he's thinking about. Now, I suppose the credit downgrade, we'll see how the market responds to it over the coming weeks. I kind of think it's going to be a non-issue. What caused the downgrade? Our debt, our deficit, those sorts of things, really important. But the fact that Moody's finally came along and downgraded the U.S., I don't know that that's going to be that significant. At least that's my take on it. Yeah. All right. Try to get to one or two more before I call it a night. From Ryan, what do I think of a 100% portfolio of S&P 500 at 30? I'm not a huge fan of not having international. I think if you got 30 years to go in retirement, you could make an argument for 100% equities. I think I was probably 90-10 at that point. I just always liked a little bit of fixed income. But I get the argument for 100% stocks. If you asked Warren Buffett, if you could have dinner with Warren Buffett, he'd probably say yes to that. I know his portfolio is 90% S&P 500, 10% Treasury bills. I'm guessing you've got an emergency fund, but I personally like a little bit of fixed income. That's just me, even at that age. And I prefer exposure to international. Warren Buffett probably wouldn't. He would probably be okay with all U.S. stocks. By the way, I read that the plan for next year at the shareholder meeting is he will not be on the stage. He'll be down, I guess, on the floor with the other directors. I didn't confirm that, but I read it on the internet, so it must be true. All right, it's 8:30, but let's try to get one more. By the way, I finished Bosch Legacy. Really good. I love Bosch. I'm starting Andor. I like the first season. So let's see here. 200 votes. 47% said you would attend. So I mean, right there's 100 people. That's more than enough. 20 said no. 20% said no. 32% not sure. It is a hard thing to know ahead of time well, it'd probably be near me, at least the first one. But when, yeah, I get it. I don't know what I'm going to do with that. I like the idea, kind of. I'd have to charge something because I'd have to pay to hold it somewhere. You guys won't fit in my house. We could all just crowd around here in the basement. Oh, I cracked myself up. Okay. Let's see if I can find one non-financial question to end the night with. Here, I'll scroll to the bottom. This is kind of a non-financial question. Thoughts on having guests join us for the live? Kat, are you saying that I need to spice things up? Just me is not good enough. So, I had Andy Penko on the show. In fact, I just did his podcast, but he and I were talking. So he's going to come back on. We haven't picked a date yet. And do I have his book handy? Where is it? Bill Bernstein. I've got his book around here somewhere. Must be over on my other desk. He's going to join the show. That'll be great. That will be sometime after July 1st. And I need to get some more people because I would like, it's fun. Believe it or not, when I have a guest on the live show, it's actually harder. It's a harder night for me. Not that that really matters. You'd think it would be easier because I get to sit back for some period of the show and just let them do all the talking, right? And there's some truth to that, but trying to coordinate it, it's tricky. But yeah, I need to do more of that. But those two will be on the show again. I don't have dates yet, but soonish. Rewatch Rogue One immediately after Andor season 2. Okay, I can do that. I'll end with this question. When should we expect the next book, and will you be doing the audio? We love the last book in audio. I'm working on several, which is probably not a good thing. I do have, so my first one was self-published, right? Here, Retire Before Mom and Dad. I just published this on Amazon. Well, it's a few other places, and it's done well. I've probably sold 30,000 copies, which for a self-published book's not bad. Paid for the cost and made a few dollars and hopefully helped some people. But I have a publisher that I've talked to for my second book. And I think they're ready to go. I just need to do it. And I've got several books in mind. Maybe I'll get your feedback on that 2 weeks from now. One book would be basically trying to answer the question, how much can you spend without going broke in retirement? How do we think about that? Which I think is maybe one of the, if you had to sort of boil it all down, retirement planning down to a single question, it's kind of that. Everything we do from when to claim Social Security, do you buy an annuity, Roth conversions, RMDs, how do you invest, is figuring out, how to spend what you want to spend and not take on too much risk that you'll go broke. So that's one kind of book. There's another book that I would like to write that's very much related to that topic, but is a separate topic, and that is, how should you invest your money in retirement? There's all kinds of books, including this one, right, about investing generally. And I think a lot of these books are, you're young and you're going to get started and you've got years to go. But when we get into retirement, investing is just very, very different, as those of you who are there know. They're just different issues. And I kind of see that you could imagine those two books together, but they could get overwhelming. So I kind of see those as two books. And then a third book I have in mind is, again, related to those two in a way. They're all kind of interconnected, is how do you deal with the fear of uncertainty, which gets me back to this free dinner I had the other night and this video I'll publish later this week. There's all kinds of uncertainty, even when you're younger, but certainly when you get to retirement age, not only with things like the market and, interest rates, taxes, but other things, how long you're going to live. Well, you don't know most of the time, what's your spending going to be look like? You have some idea, but we're still kind of guessing, in a lot of cases. So there's a lot of uncertainty. We have to make these decisions without knowing a lot of really important things. So how should we think about that? And how should we not think about that? I mean, part of that book would be protecting folks from the kinds of people I met at this dinner. Not the folks sitting next to me, but the folks presenting. I think that's really important. But I don't have a timeline at the moment, I'm sorry to say. But I'm working on it. So, all right. The annual meetup, 45% said yes. 33, maybe, not sure. It's a lot of people. We would need a big place. I'll have to figure that out. I'll give that some thought. So there you go. I guess that's it for tonight. Let's take a quick look at the calendar just to make sure I got nothing 2 weeks from now. Yeah, 2 weeks from now, June 2nd. As I like to say, Lord willing, and the creek don't rise. I'll be back 7 p.m. If you haven't subscribed to the newsletter, it's free. It goes out every Sunday. Link below this video. And that's the best way to kind of keep up to date with that sort of thing. And people like the newsletter, and I have fun putting it together. All right, enough chit chat. Hope you have a great week. And until next time, remember, the best thing money can buy is financial.